What is the history and evolution of the Basel Accords? Imagine a world where banks operate without rules, leading to chaos and financial instability. This scenario is what prompted the creation of the Basel Accords, a series of international banking regulations. Their journey began in the 1970s and has evolved through various stages, reflecting the changing financial environment and lessons learned from past crises. In 1974, the Basel Committee on Banking Supervision was formed by central bank governors from the group of 10 countries. This committee aimed to improve banking supervision globally and enhance financial stability. The need for such a body became clear after events like the failure of Bankhaus Herstatt in Germany, which highlighted vulnerabilities in the banking system. The committee, based in Basel, Switzerland, took on the responsibility of developing the Basel Accords. The first major framework, known as Basel I, was introduced in 1988. It emerged as a response to the Latin American debt crisis of the early 1980s, which revealed weaknesses in international banks' capital levels. Basel I established a minimum capital requirement, mandating that banks hold capital equal to at least 8% of their risk-weighted assets. This framework primarily focused on credit risk and aimed to create a level playing field for banks worldwide. As the banking industry evolved in the late 1990s, it faced more complex financial products and improved risk management techniques. This prompted the Basel Committee to develop a more comprehensive framework, leading to Basel II, published in 2004. Basel II introduced a three-pillar approach: minimum capital requirements that refined risk sensitivity, supervisory review to ensure banks assess their capital adequacy, and market discipline through enhanced disclosure requirements. The global financial crisis of 2007 to 2008 exposed significant weaknesses in the existing regulations. Insufficient capital buffers and inadequate treatment of liquidity risks were among the issues identified. In response, Basel III was developed and published between 2010 and 2011. Basel III introduced stricter capital definitions and higher minimum capital ratios, along with new requirements like the leverage ratio to limit excessive borrowing. Basel III also addressed liquidity risks by introducing the liquidity coverage ratio and the net stable funding ratio. Additionally, it expanded capital requirements to cover risks from derivatives and exposures to central counterparties. Further refinements to Basel III, sometimes referred to informally as Basel IV, were finalized around 2017, focusing on improving the measurement of market risk. The Basel Accords have significantly influenced how banks manage their capital and risks, shaping lending practices and regulatory oversight worldwide. They representing an evolving effort to adapt to changing financial realities and to prevent banking crises by ensuring banks maintain sufficient capital buffers against their risks. The evolution of the Basel Accords illustrates a historical progression from basic capital requirements to a sophisticated regulatory framework that continues to adapt to financial innovations and crises.